Hi, this is Thomas. Welcome to the course Financial Management. Today's lecture is Financial Markets. The financial markets connect buyers and sellers in two general ways. One is the primary market, which is when a corporation or perhaps a government wants to raise capital and they issue securities, either debt or equity securities, to investors who provide the capital, or the secondary market, which is when an investor who has a security they want to sell finds another investor to buy that security, and the original issuer isn't involved in the transaction. The financial markets increase liquidity. Investors who invest want to know they have an exit. They want to know they have a way to liquidate their or exit from their investment, and financial markets provide that exit opportunity. When an investor provides capital to a corporation who isn't listed in the public markets, then there is no good way to sell that investment. It's challenging because there isn't a public market. But when an issuer is listed on a public exchange, then there's a market into which an investor can sell their investment. So that increases liquidity. Also, the markets decrease transaction costs because of the volume of activity. It keeps costs down. There are many buyers and there are many sellers. Generally, the larger a market, the more activity in a market, the lower prices are. And one concept relating to prices in the financial markets are the transaction costs. So fees will be lower because of the volume of activity in the markets, and the perspective of cost from the issuer standpoint is either interest rate for bonds or dividends or perhaps earnings per share for common stock, and those are lower as well from the standpoint of the issuer. They can pay a lower interest rate because of the large volume of buyers that are looking for this particular investment opportunity, and they can pay lower dividends or have lower earnings per share that accrue to investors, again because of the large number of investors that are interested in this particular investment. Now, whatever the investment is, we're not discussing a specific investment here, but in public markets there are a lot of investors looking for many different types of investment profiles and risk-return relationships. So by being in the financial markets, this will, for just about every company, result in lower transaction costs. Not just the companies, but the investors as well. So this is beneficial from a cost standpoint for all participants. An intermediary is the middleman. Intermediary is sometimes referred to as a broker that will come between the investor and either the issuer or the other investor involved in the transaction. And towards the end of the lecture, we'll look at some examples of how an intermediary fee is calculated. Securities are a financial type of asset. This means they're not real assets. Real assets are things like machines, vehicles, buildings, land. Securities represent ownership interests in those real assets. In other words, you could own securities in a corporation, and perhaps you own 30% of all of the common stock of the corporation. If the corporation owns 10 buildings, then you have a 30% ownership interest in those 10 buildings. The buildings aren't in your name, the buildings are in the name of the corporation, but you own 30% of the shares of the corporation, so you have an interest, an ownership interest in those assets. What we're looking at is financial assets, primarily common stock and bonds. Securities mean that there is a secondary market, which we just discussed, for investors to liquidate their shares. When an investor makes an initial investment into a corporation, there is a market that exists for them to be able to sell their investment to another party without having the issuing corporation involved. And again, the two types of securities that we're looking at are bonds and stocks. Bonds are more generally debt securities, and stocks are more generally equity securities. Debt is a type of lending, and equity is a type of ownership. Now let's look at the concept of yield. We'll start by discussing the price-yield relationship. All securities have an inverse price-yield relationship, which means that as yield moves up, price moves down, and as yield moves down, price moves up. And we can use the yield formula to calculate yield, which is yield equals income divided by price. If we have two of these three variables, we can calculate the missing variable. So let's look at examples starting with exercises relating to bonds. We have a bond that has a par value of $1,000 and a coupon of 8%. Notice I'm describing the terms as determined by issuer. That is, as opposed to determined by the market. The market value of the bond could change and the yield of the bond could change, but the par value is $1,000. That means at the end of the bond term, the company is going to pay $1,000 to whoever holds the bond, and every year, whoever holds the bond will receive 8% of $1,000 from the issuer. That amount is $80 a year. Now our questions. If the price of the bond were to increase to $1,100, what is the new yield? We use our yield formula to calculate that value. And remember the rule, when price goes up, yield is going down. So whatever we calculate, it's going to be less than 8%. And the second question is, if the yield increases to 8.5%, what is the price? So the investor is receiving $80 a year. That's the income. If the yield were to change, if the yield were to go up, what would the new price be? And again, remembering the rule, whatever it is, it must be a lower price because yield is a higher yield. And now let's look at a common stock example of yield calculations. Same formula. The difference is that when we discuss income for common stock, income is typically dividends or earnings per share, whereas with bonds, income relates to interest. In this example, we're looking at a stock investment. The share price is $20, earnings per share is $6, and we can calculate the yield as 30% using our yield formula. Our questions: if the price increases to $24, what is the yield? It must be less than 30% because when price goes up, yield goes down. If the yield increases to 40%, what is the price? And again, using the inverse rule, since yield went up in the second case, price must be going down below $20. And then in the third scenario, EPS is increasing and yield is decreasing. EPS goes up to $9 a share and the yield goes down to 20%. What would the new stock price be? We can use the yield formula for all three of these calculations. And finally, let's go back to a concept we mentioned previously, transaction costs. Let's see how the intermediary earns fees in first a common shares transaction and then a bonds transaction. In the common shares transaction, the buy price is $14.75. That's what an investor has to pay to acquire shares. And the sell price is $14.63. That's what a seller receives to sell shares. Notice that those are not the same amount. There's a difference of 12 cents per share, and that would be the fee that would accrue to the intermediary. So what is the intermediary's fee in this scenario for a stock transaction of 10,000 shares? And our second example, the bonds example. In this case, bonds aren't shares, bonds are bonds, and they're denominated in dollar amounts. And quotes are given for bonds not in a per bond price but in a yield price. So in our example, we know that this bond has a buy yield. The buyer must pay a price that results in a yield of 4.78%, and the seller sells at a price that equates to a yield of 4.98%. Now you'll be able to use your yield formula to calculate the amount of money going to the intermediary, which will be the difference between the two prices. Now for the yield formula, we need at least two of our variables. So we're given two different yields. We don't know the price. That means that you need to know what is the income. And you can calculate the income in the second statement, or in the question. The information you're given in the question is that the bond has a 5% coupon and it's a $1 million face amount. So you can use those two numbers to calculate the income from the bond, and then you'll have the income number as well as the yield number, two different yield numbers that will allow you to calculate two different bond prices. And the difference between those two prices is the intermediary fee. And we'll see the solutions to all of these examples for the yield calculations, both for bonds as well as common stock, and here transaction costs when we meet in class. This concludes the lecture on financial markets. When we work together in class, we'll work through these examples as well as others and our case study analysis as well. I look forward to seeing you then.